market closed second quarter at nearly 17%, led by the tech sector at 42% and communication services at 36%, while the AI narrative continues to dominate the headline. On the other hand, utilities, healthcare, financials, and energy remain negative for the year. The Russell 2000 had a great run so far, and in June it had returned about 7.9%, while the Nasdaq reached 31.7 year to date. International market also fared pretty well, with the FTSE rallying 8.4% for June and Nikkei of Japan at 7.5%, while the Chinese market and the Chinese recovery narrative faced another drawback, with a modest 1% return for Shanghai CSI, that's the equal weight index, and a negative 0.1% for Shanghai SSE. Now, the S&P 500 price-to-earning ratio has steadily been increasing since December of last year. Now we are above the 20-year average of 19.6, which suggests that the market overall is rather expensive. However, the overperforming sectors mentioned above have historically had a higher than average market price-to-earning ratio. For example, semiconductor industry PE ratio is now at 105. In other words, investors are willing to pay $105 in price for every $1 in earnings. Pretty steep. On the other hand, consumer staples PE ratio is at 16, and energy is even lower at 11. June closed with money and capital markets yield higher, despite the Fed's rate pause. However, the hawkish tone maintained by Chairman Powell and the strong economic data supported the higher for longer narrative, where the economy is strong on its own without stimulus. The market closed in June with a one-year US Treasury yielding 5.41, up from 5.17 in May, while the two-year was at 4.9, up from 4.4, while the 10-year was at 3.84 from 3.64, while the 20-year and the 30-year holding around 4.05 and 3.86 respectively. Finally, mortgage rate is now at 6.71%, and mortgage applications increased by 3% from previous month, pushing the housing price index by almost 0.7% month to month.